All right, everybody, welcome to the 1031 Exchange Power Hour. My name is Chris Asteler with Exchange Resources, and today we're going to talk about all things 1031 exchanges. We're going to talk about how long it's been in existence. We're going to talk about the basic rules, and also, just some frequently asked questions that people are concerned about, that people don't know that they can actually do. So let's talk about that. Let's get into the question and answer period, and go from there. So all right, everybody. Again, welcome to the show. We are in San Diego, and we are going to be talking about LEARNin 1031 Exchange live. So people often ask me, Chris, is the 1031 exchange, is that a loophole? Is that something for only the very wealthy, that they can actually do a 1031 exchange? And the answer is actually no. It's the 1031 exchange has been around for over 100 years, and it's Internal Revenue Service Code 1031. And it helps investors defer their capital gains taxes. Let's say, for example, you're an investor and you purchased a property, so say maybe 10 years ago, and the property has been accumulating equity, and it's now worth $1 million. You have $1 million in gain. There's no debt. You've paid it off, and you want to sell it. Well, when you sell it without doing a 1031 tax deferred exchange, you're going to incur taxes, four different types of taxes: federal taxes, state taxes, the depreciation recapture. And again, with regard to depreciation recapture, that's one of the most important benefits of owning investment property is depreciation, where it actually, the depreciation allows you to reduce your taxes on your rental property while you're operating the property. One of the most important benefits. And then there's also the net investment income tax, or otherwise known as Obamacare. So there's four types of taxes that's going to equate to about 30 to 40% in taxes if you do not do a 1031 exchange. And with anything, we always recommend that you talk to a CPA to determine if a 1031 exchange is right for you. Because as an investor, you may have a lot of loss carry forwards from previous tax years, and you can actually apply that towards reducing your taxes if you decide you want to sell that investment property. And again, we always recommend you talk to your CPA. Now, if the investor were to do a 1031 exchange, that $1 million in gain, if they were able to roll that property into another property that's equal to or greater in value than what they are selling, then they can defer those capital gains taxes. Now, one of the rules is, again, by equal to or greater than your net sales price. So all of the equity has to be moved over. All of the gain has to be moved over to the new property. Also, if there's any debt that the investor has, that also has to be moved over. So let's say it's a $1 million property that they're selling. They have $500,000 in gain and $500,000 in debt. That $500,000 has to be moved over into the next property. And also that debt of $500,000 has to be replaced by either a new loan or seller carryback financing, or they can replace it with their own cash. So as long as they're able to roll over everything over into the next property, you're good. You're buying equal to or greater in value, and you're replacing the debt, and you're moving over your cash. The second rule is that the same taxpayer selling must be the same taxpayer purchasing the property. So say, for example, it's John and Mary Smith as husband and wife selling their property, their investment property. It also must be John and Mary Smith, husband and wife, purchasing the next property. In the eyes of the IRS, we are all known by our social security number. So there has to be consistency. Again, our social security numbers and our EIN numbers, there has to be consistency, because if there is a discrepancy, if, say, for example, John and Mary Smith decide to sell, but then they change their vesting, that could be a red flag for the IRS. Also, if the property is in an LLC and it's a 4-member LLC, sometimes two members want to do the 1031 exchange and 2 members do not want to do the 1031 exchange. They want to drop out of it and they want to just get paid out. Sometimes, with regard to that change, they need to talk to their CPA to make sure that there's seasoning, making sure that maybe, before they do the 1031 exchange, there's at least 2 tax years or 2 years, before they actually do the 1031 exchange, that they actually change that vesting. That way there's a little bit of seasoning before doing the 1031 exchange. The next thing is that there's a timeline. There's a total of 180 days to complete the transaction from the close of escrow. So close of escrow. So the close of escrow on the relinquished property, the investor has 180 days, but within that 180 days, they have 45 days to identify the property that they wish to purchase. So we have one of the questions coming up here on the show, and it says, when can I move into my property? The intent of a 1031 exchange is to have an investment property, okay? You cannot use it as a primary residence. So if you're selling an investment property and your intent is to purchase another property with the intent to move into that property, then that is a failed exchange, okay? However, if you turn that property into a rental for 2 years and then move into it, you can actually change the character of that property at that time. Again, we always recommend that you talk to your CPA, and that way they can see what your situation is. As long as it's approved by your CPA, then we're good to go. As a 1031 exchange company, we are a qualified intermediary. We facilitate 1031 exchanges. So as long as the CPA says it's okay, then we're good to go. Another question that came up is, can I exchange my vacation home? That is a little tricky because vacation homes actually do not qualify for a 1031 exchange. However, if you implement, a couple of rules, there's the 14-day rule, and then there's the 10% rule. If you have a vacation home and you're able to rent out that property for a period of 14 days max and use the property for a period of 14 days max, then you've rented it. You have proof that you actually rented the property, you collected rents, maybe you Airbnb'd it for 2 weeks. That qualifies, okay? The other rule is a 10% rule. If you have rented it out, that vacation home, for, let's say, a period of 300 days, you can actually use it as personal use for 10% of that period, 30 days. So you've rented it out for 300 days and you've used it for 30 days, then that qualifies for a 1031 tax deferred exchange. Again, always talk to your CPA to let them know what you're doing. That way they can go over all the benefits of, the 1031 exchange as it applies to your particular tax situation. So the next question that we have is, can I purchase my replacement property in another state or another country? So at this point in time, you cannot purchase a property in another country because we have different tax laws, and they don't, It's just not allowed at this time. So you can, however, sell and purchase within the 50 states. We can do 1031 exchanges in all 50 states. So if you sell in California and you decide you want to buy in Texas or Oklahoma or Florida or Idaho or any of those states, we do all 50 states in the nation. The next question that we have is, I own my rental property for less than a year. Can I do a 1031 exchange? So that's something that you also need to talk to your CPA about. If it's less than a year, then that could be a red flag for the IRS. However, if your intent was to own it as an investment property and you've declared it under your taxes in your Schedule E, you have lease agreements to prove that it was a rental property. However, there were some issues renting the property. Maybe it was in a bad neighborhood. Maybe there's just a lot of issues with the property. Maybe you just couldn't rent it out. You had difficulties. And we've had situations like that where investors purchase a property and somehow or another, they cannot rent it out. As long as they can show proof that they tried to rent it out, tried to market it on the different websites to attract tenants, and they've just done everything they possibly could, but they could not rent it out, then you can actually get out of it, do a 1031 exchange out of that property, and roll it into another property. However, we do recommend holding the property for at least 2 tax years or 2 years so that you can qualify for the next 1031 exchange and there are no issues or red flags with the IRS. So these are just some things that you need to consider. There's also what's called a Delaware statutory trust. And let me get into that really quickly, because there are some investors who at a certain point in their life do not want to manage properties anymore. So when should I choose the DST option? That is a very good question. And again, at a certain point in time when an investor just doesn't want to deal with the tenants, the toilets, and the trash and the turmoil of having a rental property, they're maybe in their 60s, 70s, 80s, and beyond, and they've been renting out to tenants, and they just have this headache of just dealing with the phone calls coming in the middle of the night, or all the repairs that they have to do, or driving from zip code to zip code. It gets tiring after a while. When you're in your 20s, 30s, and 40s, and you're still building up your wealth, you still have the energy to be able to deal with, and the patience to deal with, tenants. And again, with regard to California, we are not a very landlord-friendly state. Most of the laws favor the tenants, which is very difficult. It can get challenging for a lot of the landlords. So a Delaware statutory trust is a portfolio of properties that's created by a sponsor that creates this business entity in Delaware. However, the properties that are in this portfolio of real estate may be in Texas, they may be in Idaho, they may be in Chicago, they may be in other states, and they could be senior living, student housing, they could be commercial properties, they can be retail, they can be triple net leases, warehouses. So these are all brick and mortar real estate, okay? A DST is different than a REIT. A REIT is a real estate investment trust. When you do a 1031 exchange, real estate investment trusts do not qualify because real estate investment trusts have stocks, bonds, real estate, and it just does not qualify. It's considered personal property. But a DST is all brick and mortar real estate. And the benefit for a lot of investors who don't want to manage their properties anymore is they can do a 1031 exchange And let's say they want to roll $1 million into this portfolio of real estate, which is $100 million. So they own 1/100th fractional ownership of that portfolio of real estate, and they would be getting a residual income on a monthly basis based on their fractional ownership percentage. The thing is, they have no control over how the property is managed. They have no say in, the color of the paint or whether or not they should have different types of landscaping, or they just don't have a say in anything. They have no control over that property. So you're locked into it for 5 to 7 years. You can't pull out your money. However, the benefit is you don't have to get any more calls from being a landlord. You don't get any more calls from tenants. You don't have to worry about evictions. You don't have to worry about those calls in the middle of the night, but you are in there for 5 to 7 years. And if you're happy with the residual income that you're getting and the rate of return, after 5 to 7 years, you can actually roll that back into more DSTs. You can do a 1031 exchange back into a DST, or you can roll out of it and do a 1031 exchange into traditional real estate again. But for most investors who are at that age, especially the baby boomers, it's a great opportunity for them to just let go of all the management. And guess what? When the heirs receive the property, they get a step up in basis. So all the taxes that the investors have been deferring over the last 10, 50, or 20 years, the heirs who receive the property when the investors pass away, they receive it in a step up in basis, which means that when they sell it, it's tax free. So that's one of the definite benefits of doing a DST. Okay. Also, when you're doing a 1031 exchange, when it comes to the process of doing a 1031 exchange and identifying properties, you have 45 days as an investor to identify up to 3 properties. Let's say, for example, you identify 2 properties and then you have a DST as the third option. If the two properties fall out of escrow, at least you have that DST option that's an insurance policy so that your exchange doesn't fail. You can either roll $1 million of that gain fully into the DST, or you can choose to roll some of that investment into a multi-unit, condo, land. You have different options of what you can roll your investment into when it comes to a 1031 exchange, because commercial properties, land, condos, single family homes, DSTs, all these types of properties qualify for a 1031 tax deferred exchange. A lot of people don't know that. For some people, going into land and rolling their investments into land and holding it for appreciation is great, because they don't have to worry about managing that property. They're just going to be appreciating in value, and then that land then can be rolled back into a 1031 exchange, and you can buy units with it. You can buy an apartment building, whatever you want to do with that property. So there's another question that we have. I turn my single family home into a rental property. Do I qualify for a 121 tax exclusion or a 1031 tax deferred exchange? So this is a great question. Say, for example, you've lived in the property for 2 years and you've decided, I want to turn this into a rental because, I think that maybe I have a better opportunity to move into another property and increase my equity here. And I want to buy another property so that I can increase my wealth, increase my portfolio. So you can turn that property into a rental property. It will qualify for a 1031 exchange. So let's talk about what the 121 tax exclusion is. The 121 tax exclusion allows the the investors who have lived in the property for 2 years either a $250,000 tax exclusion if they're single, or $500,000 if they are married. So if you've lived in the property 2 out of the 5 years, you can get that tax exclusion. That basically means if you've lived in the property for 2 out of the 5 years, the first $250,000 of the gain when you sell the property goes straight into the bank. Okay, there's no taxes on it. If you're married, the tax exclusion is $500,000. Okay, so they've lived in the property for 2 years. Now they decide they want to turn it into a rental. If they've turned it into a rental for, let's say, 2 to 3 years, so year 1, year 2 is a primary residence, year 3, year 4, and at around year 5, it's a rental property. Before the end of year 5, if they decide to sell it, guess what? They also have the benefit of the 1031 exchange. So they get the $500,000 tax exclusion. Let's say the gain is $1 million on that property after year 5. The first $500,000 goes into the bank tax-free, and then the other $500,000 they can use to roll into another investment property tax deferred. So they don't pay any taxes on the first $500,000, and the other $500,000 is tax deferred, and they can buy another property. So these are the benefits of the 1031 exchange. There's so many different things that you can actually do with a 1031 exchange. There's many people who don't know what those options are. We've been doing this for over 27 years. We've done over 60,000 tax deferred exchanges, and we've held over $35 billion in exchange funds. And as a qualified intermediary, that is our responsibility. Our responsibility is to hold those funds for the investor after the close of escrow on their relinquished property. That $1 million in gain goes to us. We hold that for them so that they can actually go and identify the property or properties they wish to purchase. And then we take the funds and then we send it over to the closing agent before day 180. And those gains are tax deferred. So lots of benefits. So the last question we have is, can I purchase a property in another state with a 1031? And we went over that already, but we had that question come up again. And the answer is yes, you can purchase a property in another state. We do all 50 states except for Puerto Rico. Okay. So if you're looking to sell in California and buy in Oklahoma or Texas or any other state within the United States, we can do it. We do all 50 states. We are live again next week. So if you have any additional questions on 1031 tax deferred exchanges, I'm happy to answer any questions that you have. It's a great opportunity for a lot of investors to look into what the options are. Because if you don't do a 1031 exchange, again, you will be stuck with paying about 30 to 40% in taxes. So Chris again with Exchange Resources. I'm your 1031 exchange expert, and I'm here to help you build your wealth, create more cash flow, and create a legacy for your family. Please give me a call. Let's talk, and let's figure out what we can do to help you. Located in Rancho Bernardo, we've been around for over 26 years, and we've done over 60,000 tax-deferred exchanges. If you don't do a 1031 tax-deferred exchange, you could be faced with about 30 to 40% in taxes, right? Wouldn't you rather roll that over into the next property so that you can buy more with it? Well, we're here to give you your options. Let's talk.